investsense market commentary for the second week of September 2025. And it was another pretty buoyant week for markets, emerging markets in particular. There's evidence of some stimulus, especially on the monetary side in China, and maybe some green shoots, but we've been there before. Also, Japan up a couple of %, other markets up 1% or so, and a little bit of volatility overnight in Europe, just showing that markets are a little bit edgy as they again hit all-time highs. And that has been one of the headlines recently, markets hitting all-time highs again and again, and the incremental way that this rally over the past few weeks has transpired, it's ideal for those kind of headlines. Just a little bit of a thought bubble, though, that is more normal than markets falling. So markets rise over time, they grow in nominal terms if there's a bit of inflation, but also because earnings grow, etc. And so in theory, you should have markets reaching all-time highs more than they're not reaching all-time highs. But headlines like markets didn't reach all-time highs don't really catch the eye so much. But the other thing that's been in the headlines, especially for Australians, is the strength of the Aussie dollar. So it's been pretty strong for a few weeks and up 3% over the last week alone, which is a reasonably big move. It's also alongside other currencies which have strengthened against the US dollar. Now, there's a bit of a question mark there. Is this because we're in the middle of a cyclical rally and this is a sign of bullish expectations in markets, and the Aussie dollar being quite cyclical, that would fit. But on the other hand, a lot of the polemic has been more about US dollar weakness, and there's a bit of a question mark as to whether the trading patterns in currencies of the past are really going to fit. And that's something we're going to sort of talk about, because it has implications for Australian investors. And for the past maybe 10 years, not hedging has been a pretty good thing, because the Aussie dollar has weakened. So owning US dollars has been a good thing for Australian investors, but also in times of crisis, the US dollar has strengthened, especially against the very cyclical Aussie dollar, and that's provided a bit of a natural cushioning. And as you can see over the last month, actually it's not just the Aussie dollar that's sort of caught up recently, but the euro up 15%. It's actually starting to look quite expensive. And even though this is what the Trump administration have said thereafter, they might be like at some point like the dog that caught the car and not sure whether this is really what they wanted. And you can see year to date another way in which this makes difference. This is in Aussie dollar terms, that's unhedged, and you can see that European companies, some of those sort of more cyclical, out of favour investments like European equities, global small caps, ex-US, that's the grey bar, but also Japan and emerging markets up about 20%, and gold obviously up 40%. But if you look at that in local currency, or that's hedged terms, you can see that actually you would have done quite a bit better even than that, up 30% almost for global small caps and emerging markets following. And then if I put those together, you'll lose me for a second, but you can see actually that starts to make a little bit of a difference. If a large part of your international equity portfolio is diverging by 10 or 15%, this is a decision that starts to sort of make an impact. The counterpoint to this is that this follows a period of US exceptionalism, a very strong US dollar, and we're really back to where we were pre-COVID. The Aussie dollar pretty much back to where it was. In this graph, I've gone back 5 years, which is just a little bit after COVID started. And we're just below where we were. The euro is bang in line with where it was, and the pound is a little bit more expensive. But by and large, apart from the yen, it's been a bit of an up and down trip. So it might be a whole lot of nothing. But something we've been talking to our clients about is very germane to this. For the past 10 years, we haven't hedged at all from a sort of structural point. In fact, tactically, we haven't done anything like that because of the arguments that I outlined before. But this has come into question, and we've seen, if you look at this graph of correlations, it's still sort of relatively high if you look at over the last 3 years. But if you look at what's happened so far this year, and even last year to some extent, you can see that those correlations are breaking down, and there's fundamental reasons for that. The Chinese economy is not so hungry for iron ore. That has an impact on us. Interest rate differentials are perhaps more conducive to a weaker US dollar with a sharpening, with a deeper easing cycle in the US. And there's all the issues around deficits in the US, fiscal ease and how that's going to be financed and the extent to which it's going to be monetized, which all things being equal would weaken the currency. So we seem to be in a different world, and there is perhaps for the first time in 10 years perhaps, with a rationale to maybe hedge some of at least your US dollar exposure. And that's something that we've been talking to clients about. Call it sort of half of your US dollar exposure, which is about sort of 30% of your overall portfolio. And that's something that we've been talking to clients about. And it's something that we started tactically just after Liberation Day. It's kind of worked out so far. And we're seeing that as more of a strategic move now. It also fits in with the positioning of Andrew Hunt. As you know, we talked to a fair bit. And one of the things we've talked to over the last months was this sort of knife edge equilibrium between inflation and deflation, and very much centres on what happens in the US. And he's come off the fence a little bit slowly. It's a bit of a dismount, saying it really feels like it's the sort of inflationary side that we're seeing. All the incentives seem to be pointing that way, monetizing of debt, etc. But markets sentiment seems to be still quite strong, even though there's evidence of a slowing US economy. So it's sort of inflationary with a slightly stagflationary risk attached to it as well. But if you look out further out, and this is a précis, you can stop that if you want to sort of read in more detail. But basically what he's saying is that's probably going to lead to a reaction function where the powers that be, central banks and governments around the world, but especially the US administration, probably overreact a little bit. They ease too much, and that's probably why we see more inflation in 26, 27, and things could get a little bit rocky there. So sort of maybe a little bit of a dip this year, but some of the trouble might get pushed back, or the turning point back to next year. And look, for now, that means it suggests we don't really need to make too many changes, but watching things like currency, as I said before, it could be a sign of a global recovery, but it also could be a warning sign that actually US weakness is indicative of something else and a lack of confidence in the US. So sort of changing times, very difficult to predict at the moment, and that's why we'll be talking to Andrew again in the next week or so, and probably keeping in quite close contact, as this is a kind of uneasy period as we get into the year end. In terms of what we're working on this week, our segment in the newsletter is a recap of a conference we went to. It was an alternative symposium, and there were a few interesting messages, we think, for advisors around how people are positioning around alternative assets. We think they belong obviously outside of SMAs, but there was quite a few learnings and interesting discussion about how actually you parse between some of these strategies, which ones are sort of starting to look like a bit of a beta exposure compared to the more niche strategies where you probably have to do a bit more due diligence. And that leads to a discussion internally that we've had about how we support advisors in this space. So some of you will have access to the alternatives part of the portal. If you don't and you're interested, please reach out and expect more from us in helping you position for maybe some of your more bespoke higher end clients in this asset class. Sometimes people like us can seem all a bit doom and gloom, but we think there's a real role to play here to outline not only the benefits, but the things you've got to watch out for, and maybe the things that you need to tell clients about first. And that's very much where the regulator's coming from. There's obviously a lot in the papers, so there's very much two sides to the story, and we want to help clients navigate that and maybe do some bespoke work with some of their higher end, more sophisticated clients. So if you're interested in more about that, the video this week might be a little bit interesting. Look forward to talking next week. Thanks.